Good morning, everyone. This is Marshall Giller bringing you the morning comment for March 3rd. Well, the Reserve Bank of Australia surprised the markets, and me personally, and left rates on hold despite expectations of a back-to-back rate cut to battle easing inflation and disappointing capital expenditure. In the statement following the meeting, Governor Stevens reiterated that the Australian dollar remains above most estimates of its fundamental value, given the significant declines in key commodity prices. A key point of concern for the RBA remains the strong growth of lending in the housing market, which is the main reason the bank left rates unchanged. Nonetheless, Stevens did say that, quote, further easing of policy may be appropriate over the period ahead. So the door to further rate cuts remains open. Now, Aussie dollar firmed up nearly 0.9% following the decision to touch our resistance line of 0.7840. A clear break of that hurdle is needed for further extensions, perhaps towards the next resistance zone of 79, the figure. However, bearing in mind that the RBA may ease further, I maintain my medium-term view that the pair is likely to challenge the 75, the figure territory eventually. The slowdown in growth in China is likely to weigh on the Australian economy and the Aussie dollar. Now, Japan's regular base pay rose 0.8% year-on-year in January. This was the biggest gain since the year 2000. Great, no? No. After inflation, wages fell 1.5% year-on-year. So while the Abe administration is making some progress in getting companies to boost wages, clearly, it's nowhere near enough to offset their drive to boost inflation. With domestic household purchasing power falling, companies are becoming even more dependent on exports. That's likely to mean the administration depends even more on a weak yen policy going forward. For today's highlights, during the European day, we've already had the first indicator. German retail sales for January were much stronger than expected. They were up 5.3% year-on-year. That was up from 4.4% year-on-year in December, contrary to expectations that they would decelerate. Now, even though this indicator usually isn't a major market mover, the euro did strengthen slightly on the news. In the UK, later today, we get the construction PMI for January. As with the manufacturing PMI released on Monday, a positive surprise could keep sterling supported. From Canada, the monthly GDP for December is expected to rebound from the previous month's decline. Nonetheless, the forecast for December isn't enough to cause GDP for the fourth quarter as a whole to accelerate. Ahead of the Bank of Canada policy meeting on Wednesday, a weak GDP growth rate could put further selling pressure on the Canadian dollar. As for the speakers, Riksbank Governor Stephen Ingves and Bank of England Governor Mark Carney speak. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Giller, head of Global FX Strategy at IronFX Global, wishing you solid trading.